go across now to the next consumer company that we have. Mr. Shah, ED, Corporate Affairs at Symphony, is with us. Can you just talk to us about the numbers overall? Now, when I just look at the numbers, Mr. Shah, despite a 6% top-line outperformance, EBITDA estimates owing to higher ad spend were led to a margin miss. Can you just talk to us about this entire investment in A&P and the sales growth that you saw?
So during June 22 quarter, we incurred the highest ever quarterly advertisement and sales promotion expenses on account of couple of reasons. Number one, new initiatives in terms of D2C as well as e-commerce. So obviously in the initial phase at EBITDA level, they don't contribute much. But promotion and advertisement is required, even though their gross profit margin is quite healthy, even better than traditional trade. Secondly, June 22 quarter was on back of unprecedented channel inventory due to two failed summer of 21 and 20 on account of COVID. So channel was having historical highest ever inventory. So it was also in our and channel partners' interest to clear off that. And then on top of it, we had to register robust sales from company. And we are happy to share that at the end of the season, now there is a complete normal channel inventory. And secondly, EBITDA to an extent is also impacted because freight and forwarding charges have also increased due to reasons as known to all disproportionately.
So now a couple of other things. Now, if I look at the numbers on a Q1 basis, it's looking standalone. But if I look at it on a 3-year basis, the revenue number is looking great at a 9-12% CAGR. So you've got back the sales probably that you would have lost. But EBITDA is looking lower, mid-single digits. Is there a lot of inflationary pressure, supply side challenges that maybe needs to come down in the next couple of quarters?
Had there been inflationary pressure, in terms of the margin, our gross profit margin percentage would have shrunk. But if it can be observed on a standalone basis as well as on a console basis, our gross profit margin percentage, which accounts for the sales price, less bill of material and some other variable costs, it is 50.6% on a standalone basis versus about 50% pre-COVID quarter. So despite very high input costs and other costs, we have maintained the gross profit margin percentage, and that too with the minimal sales price increase. And that is on account of our continuous focus on innovation, path-breaking models, exploring variety of sales channels, and huge value engineering and cost rationalization, which we did in last 2 years. So certainly in that respect, we have not been impacted. Secondly, normally EBITDA margin percentage in Q1 is low because of otherwise also high quarterly advertisement and few other expenses. More relevant will be year as a whole, which we believe should be normalized in line with pre-COVID era.
But now that copper and aluminum prices have declined sharply, just wanted to understand how is it that you see your operating margins panning out and whether or not you're going to take actually price cuts, given that you have to make that adjustment for fall in commodity prices.
By the way, effective 1st July, we have taken actually some price increase ranging from model to model, and that will stay. But having said that, the reduction or softening of commodity prices and down the line, maybe even freight, etc., may help us in improving our operating margin, or we may take some strategic call in various respects as situation evolves.
Mr. Shah, completely digressing from this, but what's been making headlines of late is the heat wave in the entire European region. UK to all of Europe is melting, and we understand from friends and family that there's not a single AC, fan, what have you, which is even available on some of the department store shelves. So just wanted to understand whether this is a big opportunity in the offing for you.
No, you are absolutely right. So, of course, we have some presence in Europe, but we have initiated some steps, and down the line, we expect to really scale up substantially, including e-commerce and D2C. But you might be aware that there is a similar situation prevailing in United States, and there we have excellent presence. And in United States also, currently, there is unprecedented demand. However, on account of current economic situation over there, we have to offer certain promotional and discount schemes. But there also, there is a similar situation in few other parts of the Northern America.
So are you therefore saying that you're going to be looking at exporting to North America? Is that what you're saying, if I were to read between the lines?
We are already exporting in a big way in North America, including United States. By the way, we have our own manufacturing facility in Nevada. And now in United States, in air cooler segment, our market share is close to 7%, which about 3 years before was less than 2%. So in financial year 22 itself, our United States sales was in INR about 130 crore on consolidated basis, which was just less than 30 crore about 3 years before, with a robust margin and profitability.
The heat wave in America can turn out to be a new opportunity for Symphony. Already has a plant in Nevada, looking to expand that. Symphony, good set of numbers. Inventory has also started to normalize, and you're seeing bullish commentary from the top management as well as far as demand and pricing goes. Thank you so much for being live with us today. With that, we're going to take a short commercial break, but stay tuned. Many more money-making ideas coming up. We'll touch base with the top managements of buzzing stocks and our popular segment Chartbusters also on the anthem.